we're going to talk about some tax tips for individuals. On our agenda, we've got pension splitting we're going to talk about, medical expenses, tax deductible expenses for self-employed workers, as well as employment expenses for the employee, the primary caregiver tax credit, RRSP contributions, TFSA contributions, charitable donations, US and Canadian personal tax filing requirements, home office expenses in general, and new deductions related to working at home due to COVID. And then we're going to finish it off with a bit of a discussion on foreign investments. So to pick my topics, I mean, there's tons of things that you could talk about. I kind of just sort of went with the topics that I find a lot of my clients ask questions about, or areas that they seem to be a little bit unsure of, or I find other people ask questions about, other tax professionals or other accountants that aren't as familiar with tax topics. So the first thing is pension splitting. So who's eligible to pension split? Basically, any resident of Canada who's earning an eligible amount of pension income. So qualifying pension income can be taxable life annuity payments, RCAs, RSPs, RIF annuities, stuff like that. There can be dependent on the age of each of the taxpayers. So each of the spouses would have to meet certain age requirements for different types of income. And the only type of US income that's eligible for pension splitting is US Social Security benefits. So if you have a foreign pension from the States, like an IRA or 401k that you're earning income on, you do not have the ability to split that with your spouse. Up to 50% of the qualifying pension income is eligible to be split. So you can choose anywhere from $0 up to 50% of the eligible amount. And the main benefits people get from splitting pension is that you can reduce a person's income to be below the OAS clawback threshold. And also that reduces your income tax levels because it can drop you a tax bracket in some cases. It may not be both federal and provincial brackets. It may just be a provincial bracket. It all depends. But the main aspect of that would be being able to pension split so that you could take advantage of a lower tax bracket with a spouse that doesn't have as much income, and allow your person who is receiving the OAS to potentially not have to pay back any or as much of their OAS income that they've received during the year. Their requirement for it is that a T1032 pension splitting form must be completed by both taxpayers and must be signed by both taxpayers. Medical expenses are, as you get older, I mean, there's more and more that comes into play. Just ailing people's health, it seems to happen, whether it's prescriptions or just people taking care of themselves in terms of, doing chiropractic visits, or if there's an accident, physiotherapy, things like that. So you're eligible to take a deduction for yourself, your spouse, or your dependent minor children for any 12-month period that ends in the tax year that you're filing. So you can include, for example, expenses that would be from 2020, for example. We're coming into the 2021 tax filing period. So I could, if my client had significant medical expenses that maybe didn't meet their threshold requirement in 2020, so they couldn't use them, I could look at using them depending on the months that they were incurred, and then combine them with expenses in 2021. So I could go anywhere from February of 2020 to the end of January 2021, or kind of anywhere in between there. And usually you pick the period that's going to give you the most bang for your buck, kind of thing. In the year a person dies, you can claim expenses in a 24-month period instead of just the regular 12-month period. Canada Revenue's website provides a detailed list of what's considered eligible and non-eligible expense, and then the different kinds of support that you would need should Revenue Canada request proof of those expenses. Generally, if your total medical expenses are over $5,000, Revenue Canada will almost always ask to see proof of those receipts to prove that you actually have legitimate expenses, that it is for you or a dependent or your spouse, and that the right dollar amount has been claimed. So some types of things that are common is medical insurance premiums, prescriptions not covered by your insurance, nursing home expenses. So for that, that would be like attendant care. You have to keep in mind that there are a lot of times on your nursing home receipts, they break it out between rent and eligible attendant care expenses. So there's a portion of the fee that you pay. It generally ends up being about 50% of the overall fee you pay in the year that is actually allocated to rent. And then the other 50% is allocated to an actual attendant care expense. You can claim chiropractor care, glasses, hearing aids, physiotherapy, dentists, psychologists, things like that. The one thing that I find very interesting is that massages used to be deductible in Manitoba, but they're not, and they haven't been for the last few years now. I just find it interesting that the government thinks that Manitobans don't need massages, but other provinces, they are allowed to take that as a medical deduction. Medical travel is allowed as long as you travel more than 40 kilometers to seek medical services. So like your dental, chiropractor, things like that. You cannot claim travel to get prescriptions. If you travel more than 80 kilometers one way, then you can claim meals. And you can either use a detailed method to claim the meals, which means actually using receipts, or you can use a simplified method, which gives you an actual dollar value per meal up to 3 meals a day. And the same thing for the mileage. You can use your actual gas receipts, which usually is kind of hard to figure out, or you can actually just track your kilometers and then it's a specified rate per province times the number of kilometers that you get to claim. It's a non-refundable tax credit, so your medical expenses will never generate you a refund if you don't pay taxes. I have a bit of a pet peeve with this, as there are a lot of seniors that if they don't receive a lot of other income outside of their CPP, OAS benefits and stuff like that, they could be spending a significant amount of money on medical expenses, but not actually receiving any kind of benefit for it, because if they don't pay taxes, then they're not going to be able to get a credit or a deduction for their medical expenses. So that's really unfortunate, in my opinion. It's calculated using 3% of your net income to a maximum amount. So you don't end up getting a deduction for your full medical expenses, but you would at least end up getting something. You can claim for other dependents if they live with you, but you have like that are not minor children. So say you have, an ailing parent or a relative or something that lives with you that you're paying medical expenses for, you can claim that, but you have to use their threshold on top of yours as well. And you can claim expenses outside of the country as long as they qualify as eligible expenses per Revenue Canada's guidelines. Some tax deductible expenses relating to self-employed or employment. Essentially, anytime you want to determine whether or not you can deduct an expense for tax purposes, it has to be incurred for the purpose of earning income. Okay. So self-employed individuals, that means they're running a business on their own. So if I was a self-employed accountant, let's say, I work for an incorporated company, but if I was doing it on my own, I would have to ensure that the expenses that I'm incurring, if I wanted to deduct them, I would have to be incurring those expenses in order for me to do my job, to be able to earn the income that I'm earning from the business that I'm partaking in. Okay. And a lot of that sometimes depends on the type of business that you're operating, so that it would be common sense to know whether that type of expense would actually be legitimate for the type of business that you're running, or if a person was kind of just trying to skirt a bunch of expenses sort of under the table sort of thing to get extra deductions. Okay. Most of them would include home office expenses if your home is your principal place of business, or you use that space exclusively for business purposes on a consistent basis. If you're an employee, you need a signed T2200 declaration of conditions of employment. That's required, and Revenue Canada almost always asks for that. On that form, it indicates what type of expenses your employer requires you to pay for. So a lot of the times you'll see, they expect you to use your own vehicle for work. So there's a specific questions that asks you for that. It asks you whether or not they require you to use a cell phone, use a home office to do your job, that kind of stuff. Maintain incidental expenses, things like that. That's essentially what Revenue Canada looks at to determine whether or not the deductions you want to claim as an employee are allowed. Because you can't just take a deduction because you decide you want to buy something to use in doing your job. If your employer doesn't require it, generally Revenue Canada will disallow it because they say it's nice that you bought it, but your employer doesn't require it, so we won't let you take that deduction. Okay.
Great. Can I ask 2 quick questions for you, Angela, that came in? 2 quick questions that came. One is in regard to pension splitting. If I'm 65 and I've converted to a RIF, can I income split with my wife if she's 63?
With a RIF, yes, you can. With an RRSP, your spouse has to be 65 as well.
Okay. So that's the first one to there. The next one is in medical expenses. Can I claim pharmacare deductible on my taxes?
Only if you're required to pay that amount. So essentially, your pharmacare deductible is basically saying that you have to incur that much of medical expenses on your own before the pharmacare will kick in. So you can't just say,
okay.
I'm going to say this is my pharmacare deductible is $5,000. Well, you'd actually have to have $5,000 of detailed medical expenses, and that's when your pharmacare kicks in.
Ah, perfect. Well,
That's
thank you.
It's not that you actually have to pay for that.
Nope, that's great. I'll let you continue on with primary caregivers and we'll go from there. Thanks.
All right. So primary caregiver tax credit is something that's really come up a lot in the last few years because it relates to you having to care for another family member or maybe even a neighbor or something like that, where you're the main person that is assisting them in being able to function in their daily life. So this is a refundable tax credit available to qualifying individuals in Manitoba. This is a Manitoba credit alone. So it's available to individuals who are the primary caregivers for more than 90 days in a year, and they're not paid for taking care of that person. So it's a flat tax credit of up to $1,400 per year, and it started in 2018. So this is a big difference in terms of being able to claim medical expenses, which are just a non-refundable credit, which means a deduction against taxes owing, whereas this would be an actual refundable amount that you could get from the government. So if somebody had a low rate of income and didn't have a lot of tax to pay, where maybe their own medical expenses didn't qualify, or they have additional travel time or things like that that they can't claim because it's actually for another person, then they can use this primary caregiver credit to get some of a refund back from the government for providing that care. The care recipient has to meet certain needs in sort of a care perspective in order for the primary caregiver tax credit to be applicable. Okay, so mostly you have to be a resident of Manitoba. They have to reside in a private residence. So if they live, in a group home or a retirement home, things like that, that's not a private residence. So that wouldn't qualify. Generally, it would be, say your neighbor or your parents that maybe, have their ability to function on their own has sort of deteriorated over time, but they're still able to live on their own in their own house. They may have home care that comes in, and that's fine. But you need to do additional care on top of that to assist them in being able to function normally. So this gives you an idea of what an adult person would qualify for the primary caregiver tax credit. Okay, so I'm not going to go through that in detail, but essentially there's differences for adults and there's differences for children under 18 years old. Okay, there's also a requirement in this that when you fill out a form, an application to register for it. It has to be sent to the Manitoba Tax Assistance Office, and then they have to, it has the registration form itself has to be completed by a doctor or a nurse practitioner, because they have to be able to assess the level of care that that person needs. So basically, the province is looking for a third party to confirm that they actually do need this care that you're trying to claim a credit for, right? You send it in, it gets approved, and then you just kind of keep a log as to how many days you've actually cared for this person and the type of care that you're providing to them. So if you're taking them to medical appointments, if you're helping them make meals, if you're doing other sorts of things in terms of making sure they take their medication, that kind of stuff, dressing things, all that kind of stuff. Those are all sort of care ways that it qualifies. Revenue Canada may ask for a log. I've actually only experienced one instance where Revenue Canada actually asked for a log, and I think that was at the very beginning of when this credit came into play. You can't go back in prior years. So even though the caregiver credit started in 2018, if you kind of missed the boat and didn't apply for it at that time, even though the person that you're caring for would have qualified, Revenue Canada will not let you go back to that year. Your claim is for the year that you register going forward. RRSP contributions. So this is a big tax deductible option for people who are in mostly effective, or the most effective, I would say, for individuals who are in a higher tax bracket, because using an RRSP contribution as a deduction against your taxes gives you a dollar for dollar deduction for what you contribute. So it could allow you in certain circumstances to decrease your taxable income from one tax bracket down to the next. You can contribute up until the year that you turn 71, so up until the end of that year. There's a limit on the dollar amount that you can contribute. And then if you have an employer-sponsored pension plan, that can reduce the eligible amount of RRSP contributions that you can make in addition to what you already contribute to your employer-sponsored plan. Essentially with that, it's the government's way of saying not everyone has the ability to have an employer also have a pension plan available to them. So they don't want anyone who has that luxury in their mind to be able to save more for retirement than the average person. Okay. There is an issue though if you over contribute. So you can over contribute in any year by $2,000 or less. Once you go over $2,000 for an excess contribution, you would actually be required to file what's called a T1 OVP. So it's an over contribution return, basically advising Revenue Canada that you have over contributed and what month that happened, and then how many months that over contribution continues. And you'd be charged a 1% penalty for every dollar that's over that $2,000 threshold in excess of your limit. So depending on the dollar value of what that is, it could add up. I've actually had in the last 2 or 3 years, probably a handful of these that I've had to do. And it's been more prominent at times where somebody has gone on maternity leave and they weren't contributing to their pension. So then they came back to work and then they were able to do catch-up contributions to their employer's pension plan, so their work pension plan, but then that is a pension adjustment that affects their RRSP contribution room. So they still continue to regularly contribute to RRSPs, unknowingly over contributing because of the adjustment that their contributions for prior service that they missed when they were maternity leave is affecting. So there is some people that they've had penalties in the thousands of dollar ranges because of this. So it is something to just keep in mind. There's also over contributions that happen because people are confused on the type of income that qualifies to generate RRSP room. So it's only earned income. Earned income essentially is considered self-employment income, wages, You can't use investment income, which would be dividends, capital gains, interest, rental income, stuff like that. That doesn't qualify as earned income to generate RRSP contribution room. If you over contribute, you can withdraw the excess contributions to help get rid of that penalty. However, until you withdraw the amount, the penalty will apply. So it's always good to sort of be on top of that sooner than later. And a lot of times what I find is that because I don't know about my clients' contributions until it comes tax time. So if I'm aware of their regular contributions that they're doing, then it's easier for me to be able to notify them sooner than later that they're coming into a problem. But most of the time, I find out about it after they've already over contributed. So it's kind of, you need to react and deal with it right away in order to reduce the hit that they end up taking on the penalty. The penalty actually ends up applying. Sorry, I'm just trying to change my, oh, didn't want to change to start with. There we go. The penalty ends up applying on your, January to December contributions, but your actual contribution period for a given year is March of one year to February of the following year. So there's a bit of a difference in how it's looked at for there. Just something to kind of keep in mind. So as I mentioned, benefits of contributing to RSPs, they're dollar for dollar deduction. You can reduce your income to a lower bracket. Essentially, all you're doing is you're deferring your tax to a later period. But the goal is that you would not be earning your employment income in a later period. So you have a higher possibility that you would have a lower overall income level in the year that you start drawing on your RSPs or your RIFs in after turning 71, so that you would pay less tax in a future year than you would pay now if you didn't make the RRSP contribution and had a higher taxable income level. Making RRSP contributions also changes the possibility of your income being able to be split with your spouse. In retirement years, you can't split wages. So that's a potential way to reduce taxes in a later year as well. And then you can always contribute to a spousal plan as well to further access the ability to take advantage of the lower tax rates that would be applicable to spouses. What I mean by that essentially is that some spouses just may have a lower paying job than the others. So they have a lower income coming in normally, but they don't have an employer sponsored pension plan, or they don't have a significant amount of money that they put into their own RSPs. So the person who's making the contribution has to have the contribution room and would get the deduction, but they can designate the contribution to a spousal plan, which means they get the deduction for tax purposes, but the spouse picks up the income later on when it's drawn out. Okay, tax-free savings accounts. So they're very similar to RRSPs in terms of what you're able to invest in. They have limits per year. They have penalties for over contributing. The biggest difference between a tax-free savings account and an RRSP is that contributions to a tax-free savings account are not tax deductible. And essentially that's because the income that you earn on the tax-free savings account money is never taxable in Canada. So if you were able to take a tax deduction for your contribution now, it doesn't make sense that you wouldn't have to pay tax on the income that you're earning later. Okay. So again, the excess contributions are subject to a 1% penalty, just like the RSPs. You can have more than one tax-free savings account. So I have a lot of clients that have, a US dollar tax-free savings account, a Canadian dollar tax-free savings account. They've got a tax-free savings account with 3 different financial institutions. It doesn't really matter. The main point is that you cannot over contribute in a given year, no matter how many tax-free saving accounts you have. Okay. So the annual limit for 2022 is 6,000, and your annual limit regenerates January 1st of the year. So since 2009, when tax-free savings accounts were in existence, if you were 18 years old and a resident of Canada for 2009 going forward, you would have a cumulative room of 81,500 right now. Some people have more than that in their tax-free savings account because their earnings get added into the account as well. But the contribution part is only what you've contributed. So one of the other benefits of tax-free savings accounts is that when you take the money out, you can take out more than your actual contributions. And that whole amount that you take out actually adds to your contribution room. So if I had contributed the full 81,500, but let's say my tax-free savings account has $100,000 in it because of the money that I've earned over the years, earning dividends and interest, selling stocks, whatever there is in there. If I were to draw out that $100,000 in 2022, then in 2023, that $100,000 would get added to my 2023's contribution room of $6,000. So now I'd have $106,000 of contribution room. Just remember that when you withdraw from your tax-free savings account, your withdrawn amount does not add to your contribution room until the following calendar year. So that's one thing to really keep in mind, because I've had a lot of people who have actually said, oh, I took the money out, but I want to put it right back. So I'm just putting back the same amount. If you've already contributed your maximum for the year and then you contribute again, you're over contributing.
Great. Well, we'll take a quick pause here, Angela. We've gone through 6 strategies already. We'll tackle a few more questions and then finish off the last 4. You touched on RSPs, and one question we get quite frequently is, when does an RSP make sense? If you have a low income, is there a point where it's too low where you're not getting a lot of benefit? And is there a level where the income is high enough where it makes a lot of sense? Do you have kind of a rule of thumb to help out there?
Essentially, my rule of thumb with that is that if you're, it's always nice to save for later, right? So if that's your intent, is you want to put money away to just earn extra money on something to save for something else, you first look at an RRSP or a tax-free savings account. If you're in the lowest tax bracket that's possible, then an RRSP isn't as beneficial, because you're not going to get lower than that later on when you start to earn the money, right? Your main goal for making an RRSP contribution is to reduce your tax now and maybe reduce it later. So if you're in, higher than, let's say, the first or second federal income tax bracket, because the provincial brackets jump a lot faster than the federal ones. If you're in the second or third or higher income tax bracket from a federal perspective, making an RRSP is a great idea, because you're going to potentially drop down to the lower brackets, which means you're going to save taxes. And you could be in the lower brackets later on when you retire. If not, if you're not going to drop a bracket, then contribute to your tax-free savings account first. And if you have more than you're actually allowed to contribute to that you want to put away, then look at putting money into an RRSP.
Very good advice. We appreciate the tip. One more quick question here. You talked about multiple TFSAs, and we see that all the time as well. Some folks will have 2 or 3, one at the credit union, one at the investment firm, and then maybe one they manage on their own. If someone wanted to find their TFSA room just to make sure they're on side, is there somewhere they can check to make sure they're below their total for contributions?
Well, usually Revenue Canada puts your tax-free savings account room on your notice of assessment each year. I did notice that in the last year or so, they haven't consistently been doing that. So they do actually have it available in their online accounts for every taxpayer. So if you have your My account set up through Revenue Canada, you can access that yourself, or your accountant would have access to that information. Because just like our firm, I'm sure what they would do is they would have an online access to every individual taxpayer's account that they prepare tax returns for through their represent a client, right? Because it's authorizing us to speak to Revenue Canada on your behalf, and it's authorizing us to access your online data with Revenue Canada so that we can double check RSP limits, TFSA limits, tax slips that Revenue Canada has versus you have, all that kind of stuff. but generally it's the notice of assessment that would have the details on it.
Perfect. So CRA, the notice of assessment. If not, you can contact your accountant. They should be able to help out to confirm the TFSA room. So we'll let Angela finish the last 4 topics here, last 4 tax strategies. So I'll let you continue, Angela.
Okay. There is a lot of information on the different slides. So again, I'm not going through everything, but you have the ability to go back and check it out later if you want to relook at what I didn't mention or what I did mention, and you just want to confirm how the wording was. So charitable donations, these are a non-refundable tax credit as well. And it's an eligible amount that you gift to qualified donees. So those would be registered organizations. The claim limit is 75% of your annual net income. Any unused donations carry forward for 5 years, and there are some exceptions to that. Carry forward donations are claimed first. Foreign donations may only be deductible against foreign income from the same country. The only exception to that would be if you've contributed to an organization, say an educational institution or something of which you are an alumni. Then you can actually deduct your contribution to that foreign entity against your Canadian income. So a lot of times I see my clients, they have donations that they make to United States charities. And because they know someone in the States, or, people subject to Hurricane Katrina or things like that, right? So they just want to donate for a good cause. And that is perfectly fine. But unfortunately, you don't always have the ability to take that deduction on your taxes, because if you don't have any US source income, you can't deduct that contribution. You need an official donation receipt with the charity number and the date of the donation on the receipt for proof if Revenue Canada asks for it. And again, just like with medical expenses, if your donations are over a certain dollar amount, Revenue Canada generally asks to see proof of the receipts. Federal and provincial donations are done separately from charitable donations. So those are in addition to what you get to deduct for charitable donations. A larger tax credit is received when all the donations are claimed on one spouse's return. So, for example, myself and my husband could make donations to, let's say, between the two of us, we have 20 different organizations that we donated. But I donated a total of $1,000 and my husband donated a total of $20,000, let's say. So we've got $21,000 between the two of us. Well, we get a better tax deduction if one of us claims it, because the first $200, you get a lower credit than you do for the amounts over $200. So if you're both claiming them, then you have more than one sort of threshold, in a sense, that you're dealing with before you get your tax credit. You do have the ability to split the donations if you want to, because sometimes, again, because they're non-refundable credits, depending on a person's tax situation, they may not have enough tax required that they need to use to actually utilize the full donations, which is generally what happens when donations get carried forward. Okay. And the Manitoba credit for donations is different than the federal tax credit. Federal tax credit obviously is the same across the board in Canada, but every province has their own rates for their own sort of provincial credit allowed for donations. I'm dealing with Manitoba because I'm in Manitoba. So just a brief bit about filing requirements and due dates. So I get a lot of these questions every year. I mean, just especially with COVID, what's going on now, it's like, is there an extension? Is there not? When's everything due? What's happening? So Canadian tax is based on residency. So meaning if you're a resident in Canada, you're filing and paying income tax on worldwide income in Canada, okay? If you don't live in Canada, then you're only paying tax on income that's sourced from Canada, that isn't exempt under the income tax treaty that may be in existence with the country that you actually live in. Our tax system is a little bit quirky in a sense that a non-resident doesn't actually file one return to claim all of the types of income that they earn as a non-resident. You could file up to 4 or 5 different tax returns depending on the type of income you earn as a non-resident. US tax is based on citizenship as well as residency. So US citizens must abide by all the US tax laws no matter where they live in the world. So what got me started with Canadian US tax is my husband is a dual citizen. He was born in the United States, but he's lived in Canada his entire life because he grew up in a border community. I moved into this area that we live in now, so I'm just a Canadian, meaning I was born in Canada and I've lived in Canada my entire life. So I don't have that dual status filing that sort of sits with you as a US citizen. My husband has worked in the US before, now works in Canada, but it doesn't matter. He would have to file a US return no matter where he lives or where he works, as long as he maintains his US citizenship. Worldwide income is taxable in the US as well, but because there's a treaty between Canada and the US, it eliminates the possibility of double taxation. Depending on the type of income that you earn, though, that can make a difference because there are some differences between income that's taxable in Canada, but is not taxable in the US and vice versa. For example, one hot topic that I get is lottery winnings. Canada doesn't tax lottery winnings, but the US do. Doesn't matter whether the lotto is a Canadian lotto, an American lotto, doesn't matter. If you're a US citizen, you're required to file it on your return and pay the appropriate taxes. Same thing with a capital dividend account for individuals who have shares in a Canadian controlled private corporation. If they receive a capital dividend, which is a tax-free dividend to Canadian shareholders, it's not tax-free in the US. So it creates a bit of a difference. Individuals who don't earn self-employment income must file their Canadian taxes by April 30th of the following year. So for 2021's taxes, they're going to be due April 30th of 2022. Obviously, if the date ends on a weekend, it's the following business day that is considered the due date. Self-employed individuals file by June 15th of the following year, but if they owe taxes, the taxes are still due to be paid by April 30th if they don't want interest to be charged. So you still kind of have to have an idea of what your income might look like. For 2021, for example, before the end of April, if you want to make any sort of payment without Revenue Canada charging you interest. Because of COVID in the last couple of years, Revenue Canada has been a little bit lenient with interest charges and things like that and late filing penalties, just because there have been, outbreaks and things that have happened around the due dates for the returns. Extensions are not available in Canada, but extensions are possible in the US. So there's another difference in our tax system. So generally, if you live in the United States and you're filing a tax return, you have to file by April 15th of the following year. But if you're a US citizen residing in Canada, you get an automatic 2-month extension till June 15th. If you're a non-resident of the US, so you could be living down there, but you're still a deemed resident of Canada for whatever purpose, your family's still here, whatever that is, and you're earning US employment income, then you still have to file by April 15th. That's just a specific guidelines based on the type of income that you're earning. If you want to file an extension in the US, the extension has to be filed prior to the original filing deadline. So for someone living in the US, it would have to be filed prior to April 15th. State returns also have their own filing deadlines, and they are separate from the regular federal tax return, unlike in Canada, where most of our provinces and our federal taxes are all filed together as one tax return. So you have to worry about due dates for each state if the state charges personal income tax, and you'd have to worry about filing the extension for the state as well as for federal if it applies. Home office expenses. So this is a big topic that I get a lot of, and where Revenue Canada really looks at it, because it seems that almost everyone seems to think that they can deduct home office expenses if they work at home at any point in time or they own their own business. And that's not necessarily the case. So technically, in order to deduct home office expenses, and if Revenue Canada questions it, they are very picky on this and they're very adamant at applying these rules. They look to see, is your home your principal place of business, or do you use your home office space exclusively for business purposes on a consistent basis? meaning that you're actually required by your employer to work from home in a home office, and you actually have a room, such as mine, that is designated specifically as your office. It's not, a second bedroom that is used, when company comes over, or, somebody sleeps in it. It's your temporary office because you're working at home due to COVID or whatever. All those things matter in terms of if you can take a deduction and how much you can deduct. The deduction that anyone is allowed relating to home office, if you're able to claim the expenses, it's a percentage of the expenses that are based on a square footage of your overall office space divided by the livable square footage of your entire home. So when I say livable, what I mean by that is if you have a basement, but your basement is unfinished and you really can't live down there in terms of how Revenue Canada views it, then you don't have to include the unfinished basement square footage in your total square footage of your home. Okay. So in my example, if you had 200 square foot office and a 1,300 square foot home in total, you could deduct 15% of your eligible expenses. Some types of expenses are mortgage interest or rent payments, house insurance, electricity, gas, property tax, security alarms, internet, and some repairs and maintenance depending on what it is. Okay. Internet is always a bit of a tricky one, in my opinion, because if you're required to work at home, a lot of times, some people may have the internet specifically because they work from home. So it really doesn't have a bearing on the square footage of your house. And there's a different percentage that can be used in actually taking that deduction. So that's a bit of an interesting one that you may meet the requirement to be able to deduct it because you're working at home, but it's not necessarily an expense that's directly just related to the square footage of your office, which your property tax, heat, and all that is, because you don't pay those things based on which room you're in. Okay. Employees who can deduct home office expenses can't deduct property tax or home insurance unless they receive commission income from their employer. Okay. Again, like I mentioned, you need a signed T2200 to claim detailed expenses, but there is a home office deduction that's available due to COVID. So because more and more people were required to work at home because of COVID and the shutdowns, Revenue Canada tried to simplify it a bit and actually have a separate form relating to working from home due to COVID. If you want to take the flat deduction relating to home office work due to COVID, it's a different form than if you want to use the detailed home office deductions. Okay. If the detailed home office deductions, you'd actually need a T2200 with the details of what you actually are required to do from a home office perspective. So if you're working at home due to COVID, you can take a flat $2 a day deduction up until 2021. The deduction was only $400. So it was basically you could have $200 or 200 days of the year at $2 a day is what you could take as a flat deduction. But in 2021 and 2022, the government has said that they're going to increase that maximum to $500. When you think about it, you may think like, well, that's not really a lot. So, I want to do the detailed calculation. But you really need to look at that and actually consider what's involved in that, because if you don't normally work from home and you don't have an office space that's designated, like I mentioned before, you could end up having to prorate the amount of time in the day that you actually use your office for work purposes versus how much it would actually be used for personal, right? So a lot of times I find my clients say, well, I have a second bedroom, which is my spare room, but I use that for my home office. Okay, but it's available for a secondary use, not just your home office. So you'd have to consider, well, I work in my office 8 hours a day, but there's 24 hours in a day. So even though you're doing this square footage calculation and the total of your expenses for the actual period that you worked at home, you then have to prorate that again for 8 of the 24 hours a day based on the number of days you worked from home. So it gets a little complicated sometimes, and it may end up being less than a flat $500 deduction. So some people, if they don't normally do home office expenses and they don't track the information or want to keep track of that stuff, They just say, you know what, I worked from home for 180 days, give me the flat deduction. But the thing to remember is you actually have to have worked from home. I do have some people the very first year that said, oh, there's a home office deduction for COVID. I want to claim it. And then I asked them, well, did you actually work from home? And they said, well, no, I didn't. Well, then you can't claim the deduction. You don't get to claim it just because there's a potential to claim it. You actually have to have done that actual work from home in order to qualify. Okay. The last kind of topic that I'm going to talk about just briefly is foreign investments. So a lot of times my clients, because I deal with US and Canadian taxes, a lot of my clients have US rental properties, or they have vacation homes in the US that they just use for personal purposes. Or some of them have, inherited a retirement account in the States. Or maybe they worked in the US at some point in their life and now they have a 401k or 403b or IRA or something, which is a US pension vehicle in the US. And they're wondering, well, what do I do? Does that mean that I have to do this foreign property question that I keep seeing on my taxes? There's also more and more people who have brokerage accounts with their investment companies that they have investments in foreign assets. So they've got US stocks, they've got stock in Great Britain, they've got stock in China, they've got wherever it is, anywhere that's outside Canada. If it's in an unregistered investment portfolio and it's considered a foreign stock, you have to worry about whether or not you need to answer yes to this question and complete the form. So the filing requirement exists when you have foreign property, specified foreign property, costing more than $100,000 Canadian. So I could have 5 or 20 or 50 different US stocks, let's say, in my Canadian brokerage account here in Canada, but the total cost of all those is less than $100,000 Canadian. If that's the case, and that's the only foreign assets I have, I don't have to fill out this form. If I don't have that, or maybe I have some of that, but the cost is $50,000, but then I have a US rental property, maybe that I own jointly with someone else. We may have paid $150,000 Canadian equivalent for that. But if I own it 50-50 with someone else, my share is only $75,000. So I have to add that $75,000 to the $50,000 of the foreign stocks that I hold in my investment account. That's more than 100,000 Canadian. I have to complete the form. Okay. The form is different if you own more than $250,000 of foreign stocks at the cost, or if it's less than $250,000. Now, remember, it's only for investment assets. So if you have a personal use property in the United States, let's say for vacation purposes, for all the snowbirds out there, if it's simply personal use and not rented, this doesn't apply at all because it is not considered a specified foreign property if it's only for personal use. Okay. 401ks, IRAs, any foreign pension accounts are excluded from being included in specified foreign property. There's also, if you have foreign mutual funds inside of your brokerage accounts, those are generally excluded as well. So there's certain things that are applicable and certain things that aren't. But keep in mind that it's the cost more than 100,000. So I do have a lot of people that I've actually started doing their taxes for, and they say, well, I filed this T1135. And I said, well, okay, but what do you have? And then when I start doing their taxes, I realized that the market value of their rental property is more than 100,000, but their cost, their proportionate share is not. So they've been filing this form when they don't need to, which isn't a big deal if it's filed on time and done all that kind of stuff. But if you say you're supposed to file the form and you actually don't meet the requirement to, and then it's not actually filed, or you file it late or something like that, then you deal with a penalty of up to $2,500 for late filing. So that can be an issue. And this is something that Revenue Canada slaps a penalty on right away. As soon as you file late, doesn't matter, they will give you whatever penalty is applicable from the due date to when you actually file it, to a maximum of $2,500. It's usually $100 a day up to $2,500. It's due when your tax return is due. So if you have an April 30th filing deadline, You got to file this as well by April 30th. There's a question on your tax return about it, but it's a separate filing from your actual income tax return. Okay. If you have a June 15th filing deadline as a self-employed individual, then this T1135 would be due in June as well. Just because you have foreign property doesn't mean that you have to file a foreign tax return. Essentially, what I mean by this would be is if you have foreign investment property in terms of stocks. So if I have a Canadian brokerage account that has, let's say, $1 million in it, and I've got $750,000 of that is in US stocks. I'm just going to use that as an example. As long as if I'm receiving dividend income or whatever kind of income I'm earning, as long as the withholding taxes are properly taken on that type of income in accordance with the treaty between Canada and the US, I don't have to file a US tax return because I'm not a US citizen. I'm just a Canadian resident, Canadian tax filer who's earning foreign income, but that tax is being taken care of sort of behind the scenes for me. So as long as it's in accordance with the income tax treaty that Canada has with the US, I don't need to file anything. Technically, if there isn't tax deducted when there should be, I'm obligated to file the tax return in the US to give the US government the money that they're entitled to. But most people don't do that because usually it's deducted when it needs to be. And if you have a tax payment that is deducted off your slips, you get a credit for that on your Canadian tax return. Owning shares in a foreign affiliate is a different filing requirement, and that's essentially if you own 10% or more of a foreign corporation. There are some individuals that have that, so we do have those filing requirements as well. But in most cases, in terms of individuals, it's usually the T1135, and T1134s have changed their due dates and stuff like that as well, but the penalties are very similar to T1135s.
If you do have questions, if it's for Kevin or myself or our team, simply go to our website there, chatwithclintonandkevin.com. You can fill in the form, whatever it is, whether it's tax related or another financial topic. We're happy to hear from you. And if it is a very tax specific question, we can put you in touch with Angela. I'm sure she'd be happy to help out. Angela, where would you like people to get a hold of you? Do you have a website or somewhere you prefer they contact you?
Our website is ca.com, financial group. If you Google Frostiak and Leslie, will come up. My information is on there, but I'm always available through email. That's the best way to get a hold of me because I'm not always sitting at my phone.
Yeah, we can relate to that one as well.